When you look at a company's finances, what's the one thing that tells you if it's really healthy? It's not just about profit. It's about the cold, hard cash it has on hand. And just as important, the promises of cash it's waiting on. Honestly, understanding cash and receivables is like checking the very pulse of a business. All right, let's get into it.
So, here's the game plan. We're going to tackle 5 key questions. First, what does cash even mean for a big company? Then, what are these promises of payment? What happens when those promises get broken? How do companies predict that's going to happen? And finally, how do they turn those paper promises back into actual money?
All right, let's jump right in with section 1. Now, you might think, cash is cash, right? Well, for a business, the definition has some really important details that can totally change your perspective on its financial health.
So, on a balance sheet, you're not just going to see cash. You'll see this phrase, cash and cash equivalents. Now, cash is pretty much what you'd think, money in the bank, ready to go. But cash equivalents? That's where it gets interesting. These are super safe, short-term investments. And here's the key, the one thing you have to remember. Short-term means it matures in 3 months or less from the day the company bought it. That 3-month rule is everything.
Here's a simple way to think about it. Cash is for paying this month's rent and salaries. It's for right now. Cash equivalents are where a company parks extra money for, say, a month or two. It's super safe, and they can turn it back into cash in a heartbeat with almost zero risk.
And hey, don't just take my word for it. This isn't some abstract rule from a textbook. What you're seeing here is a direct quote from a financial disclosure by Walgreens. They follow that exact same 3 months or less rule. This is how the big players report their money to the entire world.
Okay, but here's where things get a little tricky. Sometimes the cash you see on the books isn't all available. It's called a compensating balance. Imagine a company gets a $10 million loan at 12% interest. Sounds straightforward. But then the bank says, hold on, you have to keep $2 million of that loan parked in a checking account with us. Don't touch it. So the company only really gets to use $8 million. But guess what? They're still paying interest on the full $10 million.
And this is the punchline. When you do the math, that's $1.2 million in interest on only $8 million of usable cash. Their actual effective interest rate isn't 12%, it's 15%. That's a huge difference, and it's totally hidden in the fine print of the loan agreement.
All right, so that's cash. Now let's move on. When a company sells something on credit, it doesn't get cash right away. What it gets instead is a promise. And in the world of accounting, that promise has a name, accounts receivable.
So what is an account receivable? At its heart, it's just an IOU from a customer. It's an asset, something the company owns, and it represents a sale that's already happened. They're just waiting for the cash to come in, usually within 30 to 60 days.
Now, of course, companies want their money sooner rather than later, right? So how do they encourage people to pay up quickly? With sales discounts. You'll see terms like 2/10, net 30 all the time. It's a simple deal. Pay me within 10 days and I'll give you a 2% discount. If not, no big deal, just pay me the full amount in 30 days.
Which, of course, leads us to the big, unavoidable problem. Giving customers credit is fantastic for boosting sales, but it comes with one massive risk. Some people are just never going to pay you.
So what do you do when that IOU, that promise you've been counting on, turns out to be completely worthless? How do you even account for a broken promise?
Well, there are basically 2 schools of thought here. The first is the direct write-off method. You just wait until you're absolutely sure a customer won't pay, and then you write it off. The problem is, that's not allowed under standard accounting rules, or GAAP, because it makes your assets look better than they really are. The right way, the GAAP way, is the allowance method. This forces companies to be honest and estimate their bad debts before they actually happen.
So let's see how that works. Imagine a company has $305,000 in IOUs, but based on past experience, they figure they're really only going to collect $280,000 of that. So they have to account for that $25,000 gap right away by creating something called an allowance for uncollectible accounts.
And they record it on the books immediately. That $25,000 becomes a bad debt expense in the current accounting period. See, they're not waiting for someone to default. They are matching the potential expense of bad debts with the revenue from the sales that created them in the first place. It's much more honest.
Okay, now let's jump forward in time. You get the bad news. A customer who owed you $15,000 has officially gone bankrupt. That money is never coming. So now you have to write that specific IOU off your books for good.
Now, check this out. Look very closely at this journal entry. What's missing? There's no bad debt expense. Why not? Because we already recognized the pain of that expense back when we made our initial estimate. This entry is just cleanup. We're just reducing the specific receivable and dipping into the allowance we already set aside.
So, all of this probably has you wondering, how on earth do companies come up with that estimate? It can't just be a wild guess, can it? Nope. It's actually a bit like financial detective work.
The main tool they use is called an accounts receivable aging schedule. It sounds fancy, but all it does is sort the IOUs into buckets based on how old they are. Then, using data from the past, the company applies a different risk percentage to each bucket. The older the bucket, the higher the risk.
And this chart drives the point home perfectly. A bill that's only a month overdue, there's a pretty low chance it won't get paid, maybe 5%. But a bill that's over 4 months old? Yikes! The chance of it being a total loss skyrockets to 40%. It's a simple, brutal truth. Time is the biggest enemy of collecting a debt.
Okay, final section. So a company's books might show millions of dollars in receivables, which looks great on paper. But you can't pay your employees with paper promises. You need actual cash, and sometimes you need it now.
So, there are two main ways to turn those IOUs into cash. First, you can use them as collateral to get a loan. This is called secured borrowing. You still own the receivables, and you still have to collect them. Or you can just sell them outright to a special financial company called a factor. The factor gives you cash up front, and then they own the IOUs and the headache of collecting the money.
But if you sell your receivables, there's one more critical detail you have to know. Is the sale with or without recourse? This all boils down to one simple question. Who's left holding the bag if the customer doesn't pay? A sale without recourse means the buyer takes all the risk. It's their problem now. But a sale with recourse means you, the seller, are still on the hook. You got your cash, but you still carry the risk of the promise being broken.
So, I'll leave you with this thought. The next time you look at a company's balance sheet and see that huge number for accounts receivable, ask yourself, am I looking at cash they actually have, or am I looking at a pile of promises they just hope someone will keep? Answering that question is how you really start to understand a business.